Well, good evening, everybody. I'm going to go ahead and get us started. Thanks so much for coming. Just to let you know, I think most of you have attended our programs before, but I'm Katie Mollering. I'm the Adult Services Librarian here at Emmett O'Neal Library. And I just want to remind you that this program is part of a series of programs that we're offering, which are funded through a grant from the American Library Association and FINRA, which is the Financial Industry Regulatory Authority. And our programs will last through May. We've got, this is our only program for February. In March, on the first Thursday evening, we're going to talk about stocks and, is there something? Stocks and bonds. And then on March 8th, Dr. Rauderkus is going to be leading a program on saving for college. So if any of you are planning on helping someone save for college, if you yourselves are saving for college, come on. I think we're going to have a good program and get a lot of good information out of that. I also wanted to let you know that we started in January a program called the Monday Morning Investment Club. And some of you joined us for the organizational meeting. This is a program that will help us continue the kinds of programming we're doing right now after the grant ends. So the grant ends in May, but we've had a great turnout. I feel like we've learned a lot. So we're going to keep this up with a meeting every other month, and we'll discuss some topic of interest. So we're going to start off kind of general, just covering the bases, making sure we understand things we've talked about like mutual funds and stocks and bonds. But we might eventually get into more specific subjects, and we'll be able to invite some of our friends that we haven't been able to have through the grant, because we're not allowed to have anyone who trades on the stock market. We can't invite any of the banks in the neighborhood. So once the grant series is over, we'll be able to invite people, you know, our neighbors here at Regions and Compass Bank and all the other banks in the area, as well as certified financial planners or anyone else that can provide us with some good information. So those are going to be Monday mornings at 10 a.m. And the schedule through May is on your Smart Investing brochure. And I'm about to put together a flyer with a schedule for the rest of 2012. So if you're interested in that, those flyers will be ready soon for, as I said, after May. Also, for those of you who were at the coffee and couponing panel on Saturday afternoon, I did a blog post today. On the library's website, you can find a link to our blog, and all of the information that I was able to get from our program Saturday is up there. So links to couponing websites, links to our presenters' websites. There's some great tips up there for saving money, mostly on groceries, but also on some retail items, household goods, things like that. So if you go to the website and look at our blog, you'll see that there. And we're also working on getting that link up on the Smart Investing page under the coffee and couponing. So the panel presentation, the video, is already there, as are all the videos from all of the previous programs. So if you missed one, if you want to go back and get a refresher, you can find them on the website. Okay, I am going to go ahead and turn the microphone over to Dr. Rauderkus, who is going to talk tonight about, I think, his favorite type of investment.
Well, you know.
Oh, he's not going to commit. But I'm going to say it. Mutual funds. All right, Dr. Rauderkus.
All right, well, thank you, Katie. Good evening. I'm glad to see you all here again. And again, I still haven't been able to run you off. And that's even though there's no threat of a final exam or anything like that. So, well, that's good. We do want to talk about mutual funds tonight. And I actually gave this talk in the subtitle, maybe all you'll ever need. Because truth be told, most people don't ever need to invest into anything else when it comes to investing in mutual funds. And we'll go through this today and figure out why that is the case. One thing, because we're actually now back talking about particular investments, I am not an investment advisor, not a broker-dealer. I am not giving you any advice. And so anything you take from here is not because I told you to do this. Okay, now, why mutual funds? Well, if you look at the mutual fund family, mutual funds are extremely popular. Now, they're more popular among investors than any other kind of investment. And there's obviously a reason for that. Now, for once, and that's one of the biggest reasons, is that you do not have to worry about actually managing your portfolio of holdings. Now, you buy into a mutual fund, and then the mutual fund manager is doing all the work for you. That's the whole purpose behind the mutual fund. So you give them your money, and they're gonna manage their portfolio for you. What a mutual fund does, just for those of you who might not know how a mutual fund actually works, it effectively collects money from everybody who wants to invest, and then takes that money and invests it in certain securities. Now, they will tell you up front what kind of securities they're going to invest the money in. That's going to be in their investment policy. And everybody who ever buys a mutual fund or buys into a mutual fund should read their investment policy. Just like with any other investment, if you do not understand what they're investing in, do not invest in that fund. Because if you do not understand the investments that they take, then you have no idea if they're doing a good job or a bad job, and what kind of risks you might yourself getting into. Got to be very careful. Always read, and not just the marketing material. Because the marketing material is exactly that. It's marketing material. It's trying to make you buy the fund. You should actually read the prospectus of the fund. Or get information about it. And at the bottom line, it says here, easy access to information. Through the library, for example, you can access Morningstar. Every mutual fund that you can buy in this country, you will find on Morningstar. And there will be analysis of that mutual fund, a nice summary of the analysis, and then there's going to be like a really long analysis of one of their financial analysts telling you everything about that particular fund, everything that you need to know. And Morningstar is, they're not affiliated with any of these fund families, so they do not issue any funds. Their only job is to analyze those funds. Now, they also analyze individual stocks, but you don't have to worry about that. But their biggest, that's how they make their name, that's what their big brand name is coming from, is by analyzing mutual funds. And every time you make an investment, you need to check for yourself. And that includes if somebody else recommends it to you. Even if you have a broker who says, well, you should really put your money into this fund, you still should go and investigate yourself, always. Because you never know why that person, now I'm not saying that they're doing that to do you harm, but for example, a broker for a particular company that sells mutual funds, they're going to try to push their particular mutual funds to you first. That's just the way they're instructed. They're supposed to do that. They will tell you they're not, but they are supposed to do that. That's just the way, because the more money somebody puts in a mutual fund, the more money there is in the mutual fund, and they make money off of the total amount of money that's invested, because they get paid a percentage of the total assets hold in a fund. So if a fund has $100 million in assets or $500 million in assets, the fund that manages $500 million is going to make a lot more money for the fund company than the one that's making that has $100 million in assets. So there is an incentive for those funds to grow. So every time somebody tells you to buy anything, you should always check yourself. And there's plenty of examples in the investment community, and that's why we have a FINRA grant, because those people end up paying fines to FINRA for exactly those kind of things, that they're not telling everything or they're not disclosing everything, and people just look at the marketing material. And the fact is, if you have a problem with your fund or with any investment, and you're going to go and sue, for example, for the money, the first thing they're going to ask you is, well, did you read the prospectus? And if you tell them no, then they will say, well, you didn't do your due diligence. You are supposed to read the prospectus. By FINRA rules investments, you are supposed to read the prospectus of any investment that you take. Now, the prospectus is not difficult to read, and they have to give it to you, by the way. they have to give you the prospectus of that fund. There's also something called a statement of additional information that you actually have to ask for. It's an addendum to the prospectus. Ideally, you should be looking at that one too, because if you said, yes, I looked at the prospectus, and the next question is going to be, well, did you look at the statement of additional information? And they say, well, I didn't look at that one. Because most people don't, because that one you don't get automatically. That one you actually have to request. So there are certain things that you have to be aware of. But generally speaking, the nice thing about a fund is it's automatically diversified. And the reason for that is because they collect money from a whole bunch of people. So they have a lot more money to invest, and therefore they can invest in a lot wider array of securities. You know, if you take your money and you want to invest money, you're not going to have enough money to buy a whole bunch of different things, because, you know, they all have a price to them, and you will not be able to create that kind of portfolio that a mutual fund can create. They're easy to buy and sell. Now, the mutual funds that I want to focus on today, which are so-called open-end mutual funds. They're the ones these are the most common kind of a mutual fund. That's called an open-end fund. There's also something called a closed-end fund, where you effectively buy shares into. An open-end fund means that you give them money, in exchange you get a share in that fund, but they are required to redeem your shares at what's called the net asset value whenever you want out of that fund. Now, there is no problem in getting that money back. Now, they're easy to buy and sell. They're only priced once a day. The price for a share of a mutual fund is only priced once a day, and it's priced as its net asset value. And what the net asset value is all the assets that the fund holds minus the cost and liabilities that that fund has. That's the net asset value. That is the price that you're going to have to pay for each share of the fund that you buy. And that's what you're going to get for each share that you hold if you sell it. The net asset value is going to be determined every day at the end of trading. So around 4:30, they're going to assess that net asset value, and if you want to buy or sell the fund, that's the price. So if you put the order in the morning, it's still not going to clear until the afternoon when they actually set the net asset value. It's only been set once a day. The net asset value of the fund is what your share is worth. The net asset value per share. You can buy in very small increments. Now, a lot of funds, they have a minimum initial purchase. Some of them, it might be $1,000, some of them might be $500, some of them might only be $100 or $50 as an initial purchase. Now, once you're in the fund, you can buy at very small numbers. The thing is, you do not have like a stock market. You want to say, I want to buy one share of IBM, so you're going to have to pay whatever that share costs. For a mutual fund, you say, well, I have $1,000. I'm going to invest $1,000 into that mutual fund, and they're going to give you the equivalent of $1,000 in shares. So you might end up with 5.756 shares. You do not have to buy in even shares in a mutual fund. You can buy and sell either by shares or by total amount. So you can also say, well, I want to buy 10 shares. That would be 10 times the net asset value, and then they would give you that. And you can say, I want to sell 10 shares of my mutual fund, and they will give you 10 shares worth. Or you can say, I want to sell $1,000. I need $1,000 out of my mutual fund. So sell $1,000 worth of shares. So they will be selling whatever $1,000 is. Let's say, might be 4.37 shares. So you're going to sell 4.37 shares, and you're going to get $1,000. You cannot do that in the stock market. You cannot do that in the bond market, but you can do it with a mutual fund. Any kind of investment you want to take. Again, most of them have a minimum purchase when you initially buy the fund. Once you are invested in the fund, you can add to the fund in any increment that you want to. It can be as small as $1 if you wanted to do that. Automatic reinvestment of earnings. So when the fund earns a dividend, when the fund earns capital gains, which they get because they're buying and selling, they're actively managed. These people, there's a portfolio manager who will actively manage that portfolio. So that person is going to do analysis on all the holdings that they have and all the things that they're thinking about investing in. and they're going to buy and sell, and they're going to make money by buying low and selling high, and all of that money is going to be automatically reinvested in the fund. And they're going to have to take that money that they make and purchase other investments with that. So it's automatically reinvested. You do not have to worry about anything. All you see is hopefully the value of each share, meaning the net asset value of the fund, steadily increasing. That's what you want to see. They will pay you a dividend. They will pay you a dividend. They will also pay out some capital gain distribution at the end of the year. If they made a capital gain, they will distribute that to you as well. Depends on what kind of fund it is. We'll talk about that in a little while. Oops. Okay. Am I doing the wrong way? Okay. Sorry about that. Okay. What's the cost? Nothing is free, neither are mutual funds. Now, there are certain costs that you can actually avoid. Certain costs that you cannot avoid when it comes to mutual funds. Front-end loads, the so-called, when you hear a fund, that's called a front-end load fund. That means that they're going to ask you to pay a sales charge up front. To be honest with you, there should be nobody in this room ever buy a load fund with an upfront load. There's no reason for anybody to do that. And one of the things to just think about the logic of it is you're effectively selling somebody, paying somebody upfront to do something for you. They haven't actually done anything for you, but they already want money. The back-end load, there's no problem there. That's a redemption fee. You're going to have to pay some fee sometimes. Not all funds have that. Where you actually sell the fund shares, they're going to charge you some money. Now you can think about it as, well, this portfolio manager made money for you, so you're going to pay that person some money because they did that. Most funds, actually, you don't have to worry about that either. Deferred loads is that some funds, they say, okay, you can buy the shares in that fund, you can invest in the fund, but you're going to have to hold the money in there for at least 3 months or 6 months or something like that. The reason why they do that is because the problem with an open-end mutual fund is every time somebody redeems their shares and sells, part of the mutual fund, that money actually leaves the fund. So that's less money for the fund to invest. They don't like that. They want you to put money in. They don't want you to take money out. And if they do not hold a lot of cash, and you come in and say, let's say you have $100,000 in your mutual fund, and you want to redeem $100,000, they're going to have to give you $100,000. If they do not have cash to do that today, they're actually going to have to go and sell some of the assets in their fund so that they can have the cash to pay you. An open-end fund is required to redeem your shares. They cannot say, well, sorry, we don't have the cash right now to pay you. If you want to sell $100,000 worth of shares, then they're going to have to give you $100,000 worth. They're required to by law, by securities law. Mutual funds are very, very strictly regulated, much more than some other funds that some of you might have heard about, hedge funds, which are basically not regulated at all, and they can do all kinds of crazy things. Mutual funds cannot do a lot of crazy things. They can do some crazy things, but they cannot do a lot of crazy things. Marketing fees, management fees. Those things everybody has to pay. Every fund is going to charge you a management fee and a marketing fee. The marketing fee is called a 12b-1 fee. It's called that because it's regulated in Regulation 12b-1. That's why it's called that. It's a 12b-1 fee, it's a marketing fee, and then there's a management fee. That's how you pay the people that actually run the fund, and that's how they get paid. That fee is not particularly high. They will tell you what they are. They will tell you that in the expense ratio. And the expense ratio will tell you what percentage is the management and the 12b fee as a percent of the fund's assets. Very important, when you read about the expense ratio, it does not include any kind of load fee. Not a front load fee or a back load fee or an early redemption load. None of that is included in the expense ratio. And the expense ratio is going to be very prominently displayed because they have to. There was a time when they didn't, and they got in all kinds of trouble. The regulations were changed. They're going to have to very prominently display to you what the expense ratio of that fund is. And that is a percentage of the net asset value that is going to go to management and 12B. We're talking normally about less than 1% to 1.5%, roughly. And you can compare. Again, every fund is going to tell you what the expense ratio is, and you can look at which fund has the lowest expense ratio, and that might be the one you want to buy. Now, the biggest thing is that a lot of brokerage firms are going to offer funds that have no transaction fees with them. Now, that does not include the management and the marketing fees, but they don't have any front-end loads or back-end loads or deferred loads. So if you have an account with a brokerage firm, you want to start first and look at their list. Which are the funds that you offer that have no transaction cost whatsoever? And they normally have a huge list of funds and that they promote. And the reason why they can do that is because the fund families that actually provide, that they sell, they want these brokerage firms to sell their funds because, again, they're making money just to the management and the 12B fee. The more people invest in the fund, the more money they're going to make. So they're willing to go to, let's say, TD Ameritrade and say, you can offer all of these, or Charles Schwab, for example, you can offer all of these funds, and there's not going to be any load. No front load, no back load, no redemption fees, no deferred load, no loads whatsoever. So no transaction fees. You can buy them, sell them for free. The expense ratio has nothing to do with your buying and your selling. That's something that you're going to be charged once a year. And we'll get to that in a minute. But other things than that, and that's what you want to look at because there are plenty of them. That's why I said there's really no reason for anybody to pay a front or back end load. Because there's plenty of funds out there now where you don't have to pay. And we're not talking about, Charles Schwab is going to offer 5 funds that have no load. No, we're talking a list of 100, 200, 300 funds that they're going to provide to you where you do not actually have to pay a load fee. And so there is significant amount of funds that you can pick from without having to pay a load fee. So there's really no reason to do that. And that can be very significant. These load fees can be very significant. And think about it, if you have to pay, for example, a 3% upfront load, that means that before you even make money on your investment, the fund has to return at least 3% just to break even. You first have to make up the 3% that you have to pay up front before you actually start making money off of that investment. So, and the same is true if you have a 3% redemption fee. Then if you only made 3% on the fund and then you sell it, the 3% redemption fee is effectively using up all your positive return. So you want to start with of the non-transaction fee funds. These are really the ones that you want to focus on.
Is there a cap on any of those fees?
There's a cap on the expense ratios, but there's no cap on the loads, not that I'm aware of. No. Okay. Now this is just a little example, very very quick example, just to give you an idea on how this actually works. I know I've never actually presented you with any math, but in this we're getting into more detail of these things. So we do have to look at some of it. So let's say you have $10,000 that you want to invest in a load mutual fund, which has an upfront load. So the load fee is, let's say, is 4%. Meaning that even though you've given them $10,000, you actually only invest $9,600. Now, because the 4% of $10,000 is $400, they're going to keep that money. So you give them $10,000, but the actual investment is only $9,600. Now, let's say that fund charges about 0.75 or 0.75% in management fee and 0.1% in 12B1 fee. These fees, and that's just generally how this is done, are charged on the average amount invested in the fund and recorded at the end of the year. So at the end of the year, they're going to look at what was the average investment that you had in the fund. And effectively, if you held the fund for the whole year, they're going to look at what was the value of your holding at the beginning of the year, what was the value of your holding at the end of the year. Now they do it a little bit more sophisticated than what I did here, but because you might have bought and sold something in between. So they're actually going to figure out what was your average holding. Here we'll just say we bought it at the beginning of the year, we did not actually buy or sell anything, but we earned 5%. So the fund returned 5%, meaning at the end of the year, I have 5% more than I had at the beginning of the year. I take the average of that, and I'm going to get $9,840 is my average holding. That's the average holding in this fund. Of that, I'm now going to have to pay 0.85%, or $83.64 in management and marketing fees. And they will be taken out. They will be taken out of my account. So that means that at the end of the year, I have a total investment of $9,996.36. That's all I have. Now, that doesn't sound that much, but you think about it, you actually made $396.36 on your fund investment. The problem is that you gave them $10,000 and they only invested $9,600 because you had to give them $400 an upfront loan. If you had not done that, you would have been much better off, obviously. You would have lost, it was a 5% increase, and you would have lost 0.85%, actually less than that because it's on the average. So you would have ended up with over 4%, 4.3, 4.4% actual return on your investment. But the problem is that you ended up paying 4% at the beginning, and then another almost percent at the end of the year, and that pretty much wiped out every dollar that fund actually earned for you. That's why we need to know these things. That's why we need to know that we have to avoid the load fee. Again, the load fee is what's dragging us down here. It's the 4% load fee that is dragging us down. And again, there is really no reason for anybody to pay a load fee, because there's plenty of funds out there where you do not have to do this. At some point I'm going to press the right button. Okay. Now, what kind of fund should I pick? When I make an investment, I need to have an objective. I cannot just wake up in the morning and say, well, let's just invest some money. And then, you open up the paper and say, well, I like the name of this company. Some people buy stock, and I'm not making it up, because they like the colors of the logo or whatever else it is. Now, sometimes you get good information. Warren Buffett, for example, not Warren Buffett, the other one from Philadelphia, Peter Lynch. When Gap just started out, he invested a lot of money in the Gap because his wife and children like to shop there. And he figured that, this is a brand that's really going to do something, and he invested a lot of money. Now, that's not a particularly scientific analysis, but it worked out for him. Now, you can just go to the mall and see which stores have people in them and which don't. And then you kind of know which companies you don't want to invest in. It's as simple as that. But with a fund, we don't even have to worry about it. We just worry about, okay, what are we looking for? Are we looking for growth? Do we want to make a lot of money very quickly? Now remember, if you want to do that, there's also a very good chance that you're going to lose a lot of money even quicker. Do I want to invest in bonds? So do I want to get a bond fund? Do I want to invest in stocks? Do I want to get a stock fund? What kind of stocks do I like? Do I only want to invest in bank stocks? Or do I only want to invest in technology stocks? Or do I want to invest in a broad array of stocks? Do I want to invest in all industries? Do I want to invest in global stocks? Do I want to invest in a portfolio that has domestic and global stocks in it? And there are funds for all of these things out there. Everything you can ever think of, there will be a mutual fund for that somewhere. So you need to think about what is my objective? Do I want to have income? Then I'm going to have to invest in a fund that generates income. There are plenty of funds out there that generate income. And they generate income through dividends. They will pay you a dividend every month. That's how you get the income from that fund. And they are invested in a way that they generate income. Do I want a fund, again, is it a capital appreciation, what I want? Then I don't want a fund that actually pays out everything to me. I want a fund that reinvests all the money they make. Because what I want is the value of my investment to go up, and so on and so forth. What's the investment style of the fund? So you know what your investment objective is, and you're going to have to match your objective with the objective of the fund. the fund is going to have to tell you in the prospectus what their objective is, what their investment style is. And when they put it in the prospectus, they have to stick to it. And again, the portfolio manager cannot wake up in the morning and say, you know, this whole you know, not so aggressive is kind of lame. I'm going to change my strategy. From now on, I'm only going to invest in like really risky stocks. They can't do that. If they do that, they get in all kinds of trouble with the SEC. And they cannot do that. If you put that in your prospectus and you say, my strategy is to invest in blue chip stocks, meaning stocks that are all in the Dow Jones, 30 biggest companies in the country. Those are the only stocks that I'm going to invest in. Then I cannot invest into any other stocks. If I say in my prospectus, okay, at least 5% of my holdings are going to be in cash, I need to have at least 5% of my holdings in cash. I cannot say, well, you know, I just keep everything 50% of my, I don't trust the market right now, so I'm going to keep 50% of my money in cash. You can't do that. That's why being a portfolio manager is really difficult, because you're very tempted. And it's same with, you know, somebody gives you a tip or you find this, you know, this so-called hot investment. You can't do this because your investment policy says you have to do this and this and this, and you can't do anything else. And that's why you need to read that prospectus, because it's going to list in there what their investment objective is and what their investment style is, meaning how are they going to meet that objective. What investments are they going to take? Are they going to invest in value stocks? Those are stocks that they analyze and they figure out that they're undervalued. And they're going to find those stocks, they're going to invest in those, for example. Or they're going to invest in growth stocks. Those are stocks that they expect to grow at double digits. 10, 15, 20% growth rates in sales over the short run. Those are the ones they're going to invest in. They will tell you that. They have to. They cannot just say, well, I'm opening a mutual fund, and I'm just going to invest it in something. That you're not going to be able to sell that in the market. It has to be specific. You need to have an investment policy. You need to show investment style. You need to show a performance record. They will show you a performance record. Got to be very careful with the performance record. It's got to actually be compared to something that makes sense. In other words, you can compare everything to everything. You can actually compare apples to oranges, but the comparison is not really particularly accurate. But that doesn't keep you from doing it. You can still compare apples to oranges, and they can compare, you know, a stock fund can compare its performance to a bond index. They can. It means nothing, but they can do that. So it's very important that when you're looking at the performance and when they compare it to something else, it has to be something that's actually comparable. So if I have let's say I'm a small cap stock fund, I can compare the performance of that stock fund to a small cap stock index. There is such a thing. And see, okay, that small cap index performed 25%. My fund performed 10%. Clearly my fund didn't do so well. Now, I might have done 10% and say, oh, I'm so happy I have 10%. But truth is, everybody else who invested in small cap stocks on average made 25%. So clearly, my portfolio manager is not doing a very good job. So I might think about some different investment. Relative to funds of its type, look at all the other ones. So how they do it, and Morningstar actually does all these things for you. Morningstar is going to tell you what the performance is. They're very good, and that's much more believable than looking at some of their marketing material. There have been some cases where, for example, some bond funds that were invested heavily in some very risky structured finance products would compare their performance to just the basic non-investment grade corporate bond fund, or corporate bond index, which the two have nothing in common really. But say, well, look, we're outperforming this index, look how good we are. You should be outperforming that index because you're taking a lot more risk. So if you compare a small size, small cap stock fund to the Dow Jones index, you should always do better than the Dow Jones. Because investment in a small cap company, those are small companies. is a lot riskier than investing into a multi-billion dollar enterprise like Procter & Gamble or ExxonMobil. There's a lot more risk involved in doing that. So you should be getting a better return. Now, we talked about risk and return on one of our workshops. The more risk you take, the higher should be the return. And you have to compare apples with apples. You have to compare the performance of your fund with a fund that takes the exact same amount of risk. Because if they take less risk than you do, and they do better, or even if they do just as well as your fund does, with taking on less risk, your fund is not doing very well. You can say, well, I still make 25%. Yes, but you're taking on a lot more risk than another fund that does also 25% with a lot less risk. So the chance of you actually losing money was a lot higher with the fund that you were in than somebody else had. And that's what you have to look at. How is my fund doing relative to all the other funds that are doing the exact same thing? And that's what you have to look at. And again, Morningstar is a great resource for that. And we do have that in the library, though. And you can go on that. It's online as well. Expense ratio, we all talked about that. Fees expense ratio. You want to look at that, and you want to compare them to the other funds. Again, there's plenty of funds out there that have no transaction fees whatsoever. Expense ratios, every fund is going to have an expense ratio. They're all going to have management fees. They're all going to have marketing fees. You do have to pay the portfolio manager's salary. That person does want to make a living too. So that salary has to be paid somehow, and it's paid to the management fee. Now again, the management fee on mutual funds is relatively low. Now if you go into other funds, you see sometimes management fees of 2–3%. Now, which is a significant amount of money, where people can make a lot of money if you're able to get enough people to give you money. So those are the things that I want to look at.
Sorry,
yes.
What's the difference between small and mid-sized and large cap? Is it just kind of small caps are more risky, or? Yes,
small cap, medium size, and large cap is defined by what's called the market capitalization of the company. Market capitalization is the number of shares outstanding times the stock price. That's the market cap. Like what we've had in the newspaper, just recently, this week, actually yesterday, was Facebook going public. They want to go public and issue stock. The company is going to be valued at about $100 billion once they're going in. The market cap of that company is going to be $100 billion. Good old Mark Zuckerberg is going to own 28% of that. So he really, I think he's going to be the 5th richest man in America once this IPO goes through. Yes?
You said the difference between the small, mid, and large cap stocks is defined as the number of stocks
times the number of shares times the stock price.
Okay.
So that way you can figure out, now a large cap is your Dow Jones company. We're talking, companies that have in excess of $1 billion in market capitalization and more. The medium cap is somewhere between $200 million to $1 billion. And then the small cap is anything with less than $200 million, give and take. Now, $200 million, that sounds like a lot of money. No, it is a lot of money. But in terms of publicly traded companies, it really is not. Now, that's not a lot of money. $200 million is not a lot of money in terms of market capitalization. So, which means, in terms of the company, a small company has a much harder time to make it through a recession, for example, or make it through bad economic times than a large company. If a large company has a lot more reserves and they have other markets that they can be in, they're more internationally diversified and things like that. So it's a matter of a number of shares times the stock price, and the smaller the market capitalization, that's why these things are called small cap, medium-sized cap, and large cap, cap standing for market capitalization. It's based on total value. You can think about it in terms of, if you wanted to buy the entire company, if you wanted to buy every share that's outstanding for that company, that's how much you would have to pay. If you wanted to be 100% shareholder of that company, that's how much you would have to pay. And again, as I said, Facebook is going to be valued at about $100 billion, and Mark Zuckerberg is going to have 28 billion on that, because he owns 28.4% of the stock. of the stock. And now he owns actually more than 50% of the voting stock, or 28% of the total stock. So he's going to be worth $28 billion. That's why he can afford to only take a $1 salary. So he only takes a $1 salary, just like Steve Jobs did. He only took a $1 salary. Puts you in a much better tax bracket too, because now you're only paying capital gains tax. You're not paying income tax, so you're paying a lot less money on your income if you do that. Now, what kind of funds? Long-term investors. If you have a long-term investment goal, meaning beyond 10 years, what kind of funds do you want to look at? Growth funds, funds. Again, those are funds where you expect capital appreciation, where you invest because you want the net asset value of that fund to go up over time. So when you redeem the shares later on, you're going to get more money back. That's growth funds, and they're going to invest in companies that are growing. Basically, all of these are mostly invested in equities. Now, equity investment is a long-term investment. Equity investment is not a short-term investment. You do not invest in the stock market so that you can make enough money to pay or to go on vacation in the summer, because that can very easily turn against you. These are most of them growth and income, means there are some growth stocks in there and there are some income stocks in there. So they're not so much investing in income securities like bonds, but they're going to invest in income stocks like utilities, for example, stocks that pay a high dividend. Utilities companies pay very high dividends. Now, the definition of a high dividend in the stock market is somewhere in the 3-4% dividend yield. So 3 to 4% relative to the stock price. We're not talking, they're paying out, 10, 20, 50, 25, 30% of their stock price in dividends. We're talking very small. We're talking 3, 4, 5%. That's called a high dividend yield stock, or an income stock that pays that amount of dividend. Index funds are very, very interesting funds. They're basically just linked to a stock index or a bond index. So you can buy a stock that tracks the S&P 500 stock index. What that means is that the performance of your stock, of your fund, is going to be directly linked to the overall stock market. Not to one particular sector of the stock market, but the stock market as a whole. Index funds are, if you just want to invest in the stock market and you really don't know which part of it, those are perfect for you. Right there, you have something that tracks just that market. And if the market goes up, so does the value, because they need to track that. Now, they do not buy the S&P 500, but they construct a portfolio that looks just like the index, and it's going to move just like the index does. And so you're going to make money with a stock index. So if the stock index goes up, your portfolio goes up. If the stock index goes down, the value, net asset value of the fund is going to go down. It's a broad investment in the stock market. It is not an investment in particularly growth stocks or in value stocks or in income stocks. It's an investment in all of them. And the S&P 500 represents 500 publicly traded companies. Therefore, you are now invested in 500 publicly traded companies if you buy an S&P 500 stock index. Global funds are funds that are globally invested. Now there is actually a difference between global funds and international funds. The main difference is that most global funds, they invest in everything, including the US. So if you buy a global fund, it's not going to be all foreign stock. There's also going to be some US investments in there. There are US-based companies. An international fund is only going to invest in non-US companies. So let's say if you hear that the Chinese stock market is doing great, or the Indian stock market is doing great, you can invest in the Chinese and the Indian stock market. You don't have to go to China and India to do that. You just find yourself as a mutual fund that invests in the Indian or the Chinese stock market, and you give them dollars. You don't have to worry about exchange rates or getting rupees or yuan or anything like that. You don't have to worry about any of this. There are funds that specialize in investing in those, or they just invest just in East Asia, or just in Latin America, or just in Europe, or just in Eastern Europe, just in Northern Europe. Yes?
Let's say I took my $10,000 and I invested in a global fund.
Mhm.
And then I decide, well, India's doing so much better, and China and the US is doing terrible, so I want to switch to an international fund. Can you do that whenever you want? You just harass your broker, or do you have to wait?
Well, you
How
don't-
does that work?
You don't even have to harass the broker. But no, all you got to do is you sell your global fund and you buy an international fund. And that's a one-day transaction. So you put in an order and say, I want to sell my global fund. I want to sell whatever my holding is. So that sale is going to go through by the end of the day. And then you can buy your international fund as soon as you get the funds from selling the global funds. So no, and you can do that if you have an online broker. You can do that online. You don't have to ask anybody to do that. It's just all you do is press a button. Now you all still have to think about if that's really the fund that you want before you press that button. But you can do this all very easily. That's buying and selling investment. If it is stocks, if it is mutual funds, buying and selling mutual funds is very, very easy. There's nothing to it. It's very, very easy to do. You can do it yourself online, or if you get a broker, you're gonna get it. You can do it with a broker. Different between doing it online and doing it with a broker. Normally, it's cheaper to do it online. But again, as far as mutual funds are concerned, if you get a fund that has no transaction cost, that's not the same as buying stock. Like if you buy stock, even online, they're going to charge you maybe $4.99 or $5.99 or $9.95 per trade. The mutual funds that I mentioned before, the no transaction fee funds, you do not have that fee. There's no cost to you whatsoever when you buy or sell those funds. Again, the only cost that you have is the marketing and the management fee that is going to be deducted from your fund holdings at the end of the year. And that's going to be less than 1%. That's the only cost you're ever going to have with those kind of funds. Then we have socially responsible funds. Again, there's a fund for everything in there. So that socially responsible means that if you don't want to, you want to make sure that whoever you invest in does not invest into companies that make tobacco or firearms or gambling. You can do that. There are funds out there that will say we do not invest in those. They have it in their policy. They will say we cannot invest in this and this and this fund. I remember, and we do these things at the university. We actually have student-managed investment funds. We have one at UAB. We have one at the school where it was before. School where it was before was a Catholic school, so we actually had a socially responsible fund. They were not allowed to invest in companies that were selling tobacco, firearms, or gambling. No, they just wouldn't let us do that. But at UAB we have a fund too. They actually won first prize in national competitions 2 of the last 4 years. And they do the exact same thing that an actual fund would do. We just do it as a, and they have real money, so they're investing real money. They're not just doing monopoly money, but they actually have $500,000 that they're investing. We advise them, but they make the decisions. We're never going to say you cannot invest in this company. They're making the decisions. But so there's all kinds of different funds, but most of these funds are all going to be equity funds. They're going to have an investment in the stock market, and that's where you want to go for long-term investments. That's still the best place to be for long-term. Short-term, the market goes like this, but long-term, it goes like this. Now, long-term, again, I'm talking 10, 15, 20 years. That's long-term in the stock market. If you go in the stock market, short-term, you're not investing, you're speculating. Now which people do too. But if you wake up in the middle of the night with nightmares about your stock investment, then you're not investing. Then you're actually speculating. You have to have a long-term perspective in these things. Now again, that's why when you're looking at when do we invest in these things, you obviously are not going to invest in a long-term stock fund when you're 75 years old. That doesn't make any sense. You do this when you're in your 20s and your 30s, and then the older you get, the more you scale back on those kind of funds, and the more you're going to go into these kind of funds. Which are the funds for the income-oriented investor? Funds that are going to generate a steady income for you. That income coming from dividends. These are the kind of funds that are going to pay you a monthly dividend. And a significant monthly dividend. Because what they're doing is they're investing in fixed rate securities, in bonds. These securities pay an interest rate, a coupon rate every month. And that coupon rate that these bonds pay is going to be passed on to the mutual fund holder. That's not going to be reinvested unless you want it to. In other words, you can have the dividends that they pay you reinvested in your fund if you do not need the income. You can do that. But if you live off the income, then they're just gonna put money in your account every month. And the money that they make comes from the investments that they invest in. And they invest in bonds, which are fixed income security. These are debt securities. And with like any debt, there's a monthly payment associated with these. Monthly, or with corporate bonds, for example, they pay coupons every 6 months. But you have to think about that the mutual fund is not just going to invest in one bond, but they're going to be invested in a whole bunch of bonds. And between all these bonds, there's still going to be corporate interest payments made every month, because every bond makes an interest payment in the different months. Each individual bond only going to make a payment every 6 months, but between all of them, there will be payments coming in every month. Global bond funds, not only investing in the US, but also in globally. Government bond funds invest in treasury securities. Ginnie Mae funds, for example, now I should have updated that. They don't call them that anymore because we don't have officially Ginnie Mae anymore. It's the Federal Housing Finance Authority now, which holds Fannie Mae. Sorry, not Fannie Mae and Freddie Mac. Ginnie Mae actually still does exist under its own. It's a government-sponsored entity, so it's backed by the U.S. government. It's just not the Treasury. It's Ginnie Mae. Municipal bond funds are going to invest in municipal securities. Municipal bond funds are federal income tax free because interest from municipal bonds is federal income tax exempt. You do not have to pay income tax on income that is generated by municipal securities. And that same is true for bond funds that invest their entire amount of money in municipal. You have to be very careful. If you have a fund that just invests some of its money in municipal bond funds, then only that portion of that interest that you get, or dividend, is actually tax-free, the rest is not. But if you get a municipal bond fund, they will pay you a dividend every month, and there's no taxes to be paid on that. Obviously, anything that's tax exempt works particularly well for people that pay a lot of taxes, and really doesn't do anything for people that don't pay any taxes at all. So a tax exemption doesn't do anything for you if you don't pay taxes. And a tax exemption is going to make a lot of sense for you if you pay taxes. It makes even more sense for you if you pay more taxes than the average citizen does. Because the way these things are priced is based on an average tax rate. Because it's going to be priced into that security that you're going to get a tax exemption. So the interest rate earned on a municipal bond is always going to be lower than the interest rate earned on a corporate bond, because you get a tax exemption. You need to earn more interest on a corporate bond to have the same amount of after-tax income that you would get from a municipal bond. Otherwise, nobody would ever buy it in the market. So, if you have more, if you earn more, if you pay more taxes than the average market participant. In other words, if you're in the highest tax bracket or close to it, any kind of tax income exempt security is a great investment for you. If you're not paying any taxes or you're in the lowest tax bracket, they're not doing anything for you. That tax exemption does not work for you. It just makes doing your taxes easier because you don't have to worry about putting them in. You know, that's all. You don't have to. You get a 1099 form that says there's no taxable dividend or interest income earned on your investments. That's all. But other than that, from an actual after-tax return, if you don't pay taxes, you do not need to have money in income tax-free funds. But these funds are all fixed income funds. They pay income. These are the funds that you want to invest in if you want to generate a steady income. Now, having said that, you've got to be very careful. You've got to read the prospectus. gotta read and, okay, what kind of securities, what kind of bonds is this particular fund investing in? Because some of the things that you get is these kind of funds. These are funds that you don't necessarily, some of them are very risky. Aggressive growth funds are very risky funds. You can make a lot of money, you can lose a lot of money. Those would be invested in companies that you expect to aggressively grow. As far as income is concerned, high yield or junk bond funds, that's where the trap is. That's where the trap is for the person that, well, I really want income and I want to get as much income as I can, so why don't I invest in what's marketed to me as a high yield bond fund? High yield is just another word for junk. Junk means in technical terms, non-investment grade. And all these things are being rated by credit agencies and they're non-investment grade. Now, if they just invest in non-investment grade bonds, you don't have much of a problem. The problem is that a lot of these high yield bond funds do not just invest into non-investment grade corporate bonds, but they invest in collateralized mortgage obligations, and collateralized debt obligations, collateralized loan obligations, all these things that we generally call structured finance products. The ones that caused all that trouble that we had in 2008 and 2009. And some of these do not exist anymore, but some of them are still around. And they invest in these because they generate enormous amounts of yield. That's why they invest in those, but they're also crashed. And they have no way of recovery. See, the other thing about a bond is, a corporate bond is a loan. It's a loan from a corporation. If they don't pay you, then you can take them to court. There's recourse. You know, they can go bankrupt and you're going to get some money. The structured finance product, depending on what part of that structured finance security the bond fund invested in, there is no recourse because there's no default defined. So if they don't get money, then you're just out of luck. And the way these things are structured, once you do not get the money, that normally means that's because the money is not there and it's gone forever. So you will never be able to recover that investment, and the fund is never going to be able to recover that investment. These are very, very, very dangerous funds. So if your purpose is to generate income, and you hear the word high yield bond fund or high income fund, got to be very careful and look and read very carefully exactly what kind of high income securities that fund is invested in. And again, it will tell you in the prospectus. It will tell you we're going to invest this percentage of our money in these kind of securities and that percentage in that kind of securities. And you have to read that very carefully. That you don't, and you can't just trust the marketing material. Too many people have and lost a lot of money. There have been lawsuits all over the place. Now, again, company like Morgan Keegan had to pay $200 million to the SEC in a settlement without admitting any guilt, but they paid $200 million in settlement fees. And Regions sold them. Regions sold Morgan Keegan at a significant loss. They had to take a $750 million charge against that sale. So they had to sell them undervalued. There's a company that did some things where investors lost a lot of money. And they were not exactly 100% truthful in what they're actually said in the marketing material. Or they made it sound better than it was. I shouldn't say they weren't truthful. There's always different ways that you can describe something. And some things might have sounded much better than they actually were. And got to be very careful. If somebody promises you a high yield, it comes at a price. And the price is increased risk. And you got to be very careful that you know exactly what you're getting yourself into. It sounds great, so oh, this fund is going to generate a high dividend, pays high dividends, makes an 8, 9, 10% return. Look around. If you go to the bank today and you put your money into a 3-month CD, you get like 0.5%. If you put your money in a 3 months treasury bond, you get 0.05% return on that. If you invest your money in even in a 10-year bond, you're going to get like 3% return on that. If somebody comes to you and says, well, I can generate a 15% return on that bond fund, and you look around the market, and there are bonds out there that generate a 15% return, they are all issued by the government of Greece. You know, these are going to generate a 15%, they will, if they do generate return, but if you actually get the money, you will get a 50% return on the investment. But there's a reason why they pay 50%, because there's a very good chance that you're not going to get the money. So you're going to have to look at what is the market doing as a whole. So if interest rates are very low, as they are right now, somebody promises you 10, 15%, you're going to have to take some significant amount of risk to make that happen. Because the non-risk investments or the low-risk investments are not going to give you 10, 15%. The market just doesn't have those numbers right now. That's not the environment that we're in. Fixed income is going to be low in the market that we have right now, because interest rates are very, very low. So you got to be very, very careful. Single industry funds are dangerous, or are risky, I should say, because they only invest in one industry. And we talked about, one thing about a mutual fund is that you can diversify, or they diversify for you. They can diversify much better than you can personally. They can, buy stocks or bonds from different industries, different companies and different industries. So if one industry is suffering, the other industry might not, and it kind of balances out. So what you lose on the one hand, you might gain on the other hand. So the risk is kind of neutralized. If you're in a single industry fund, and you happen to be in an industry that now goes through a very rough time, then your entire investment is going to tank because of that. Because there's no diversification. The only diversification that you have is in terms of, okay, I don't have all the money, they did not all invest all the money in one particular bank, they invested them in 20 different banks, but the stocks of all those 20 banks went down, because then what happened, for example, in 2008, they all went down. So if you had invested in a single industry fund that was only invested in banks, then you would have lost a lot of money. That's what a single industry fund means. You do not get the benefit of a diversification. A relatively new product is sometimes called an exchange-traded fund. Now, the difference between an exchange-traded fund and a mutual fund is that it actually is bought and sold like a stock. They're so-called ETFs. You might have seen that come across, if you read the paper, you might have come across something called an ETF. That's an exchange-traded fund. They are bought and sold like stock. What that means is, unlike a mutual fund that's only been priced once a day at the end of trading, and you can only buy or sell it, or your purchase, I should say, does not execute until the end of the trading day. If you buy or sell an ETF, it's going to execute right away. It's bought, there will be a price, and the price is determined by supply and demand of that stock. And that supply and demand, or the price, is based on the net asset value, but it's not necessarily going to trade at the net asset value. There are no load fees for those, but you have to pay a brokerage commission because they're traded like stock. So you do not find a exchange-traded fund that has no transaction fees. Not like the mutual funds, where you do have a lot of them that do not have transaction fees. Generally speaking, as far as mutual funds are concerned, the reason why they are so popular is because you do not have to do the research. Again, if you think about, okay, I want to invest, I want to have a portfolio that's invested, half of it is invested in technology, and another quarter of it is invested in the financial sector, and another one is invested in the industrial sector, let's say. That's great, but now you have to go out and you're going to have to research every single company to find the actual company that you want to invest in. And that's going to take a lot of time and a lot of effort. In a mutual fund, that's what the portfolio manager is doing for you. The portfolio manager is going to outline in the investment policy, these are the industries and the securities that we're going to invest in. Those are the types of securities. So we're going to invest our money in financials, and we're going to invest some of our money in technology, some of them telecommunications. And you say, well, that's exactly what I'm looking for. And then the portfolio manager is going to do the homework and going to find the particular companies that fit that particular investment profile. If it's growth, if it's in value, they're going to look for that particular stock. That's what they do. That's what they get paid for. They're going to come up and they're going to tell people, these are the stocks that I'm going to buy and sell. Now the portfolio manager is actually not the one buying and selling them, and the portfolio manager is going to call a trader and say, buy and sell those stocks for me. But that's all internal with the company. And that's one of the things that you pay for in the management fee. But that's what a portfolio manager does. That's what they do all day. That's all they do all day, is to figure out which companies should I invest in. And they're monitoring all the investments. And if they see some trouble, then it's their job. They have a fiduciary duty to make sure that the fund performs well. They cannot just say, well, I don't really care, and just turn off the computer and just sit there and watch television. You know, they can't do that. They have to actually actively manage the fund. They're required to do so. And that's what they get paid for. Now again, some portfolio managers are better at it than others, like with any other job. And that's why you have funds that perform very well, and you have funds that do not perform very well. And then you have funds that perform very, very poorly. That's why up front, you're going to have to look for the ones that perform well relative to their peers, and you avoid the ones that perform poorly relative to their peers. That's where your research comes in. That's what you have to do. You do not have to worry about where they actually invest the money once you gave them the money. That's their problem. That's why you have a mutual fund, so that you do not have to worry about the holdings. Now, which company should I invest in? But you just have to worry about which fund is the right one for me. Yes?
Are there any other resources besides the prospectus and Morningstar that you can do your own research on?
There are, there's magazines, there's mutual fund magazines, there's all kinds of other written material that you can find. You can reach them. There's Lipper, and then there's other agencies other than Morningstar where you can research funds. Now Morningstar in itself is a neutral source. That's a good thing about Morningstar. They do not issue their own funds. Now you can get research from Goldman Sachs about a fund that they sell. That was probably going to be a little biased. And also, they still have to tell you the truth, but it's also a way of how you phrase the truth. You know, but Morningstar, you have a fairly neutral approach to them, and they are the industry leader when it comes to. That doesn't mean that Morningstar doesn't make mistakes. You know, everybody makes mistakes, but they're monitoring those funds, and Morningstar, every time they see a change, they're required to update their report. They don't do it like every week or every month. Only if something actually happens that requires updating, they're going to update the report. But there are other sources, but most of these are going to cost you. Morningstar you can get here at your local library for free. And it's a great resource. But yes, there's periodicals about mutual funds and so on and so forth. So there is a lot of other information out there. But when it comes to mutual funds, Morningstar is the market leader. Now, if you're looking for a particular stock or bond information, there's a lot of other places where you can go. But if it comes to mutual funds, most of the large investment firms, they're not going to focus so much on mutual funds. They're focused more on individual stocks, because that's how these companies, you know, but like if I am Fidelity, I have funds. I have my own funds that I run. So my analysts are going to look at particular industries and they're going to find the stocks to put in the fund. And I'm not going to spend a lot of time analyzing other people's funds. I'm just going to do the stocks. But Morningstar, that's how they started, is doing mutual fund analysis. So they have an expertise in that. Yes.
You haven't mentioned real estate investment.
Yes, you can invest those. They're a little different in terms of how they're set up and in terms of what they're required to do. But no, you're absolutely right. There is what's called a REIT, R-E-I-T. It's called a real estate investment trust. Those are funds that invest only in real estate. Now, there's also among those funds that you can find real estate funds that might invest in companies that own real estate. You know, companies that manage real estate. So there's different kinds of, the real estate investment fund normally might actually invest in real estate. So they might own office buildings, and they're going to generate income from that, and then they're going to distribute it to their investors. That's why they're different, because they might actually own the real asset. Whereas in a mutual fund, they go out and they buy securities. A real estate investment trust might actually own the real asset, but there also might be mutual funds that invest in the real estate industry. There might be bond funds that invest in Fannie Mae and Freddie Mac securities, for example. Those are real estate-backed securities. So they might invest in those. There might be, regular mutual funds that invest in companies which, like Colonial Properties, for example. Which job it is, just they are a real estate holding company, but they're publicly traded. So, you know, you can buy their stock and benefit more. Harvard, you know, some companies like that. You can buy their stock and benefit from that. Also, but real estate investment trusts are not mutual funds in the sense of what we're talking about tonight. They're different, and again, they are required by law to actually distribute most of the earnings to their investors, and there's different tax implications on REITs and so on and so forth. But you're absolutely right. There are real estate investment trusts out there, but it's not in what we talked about here, a mutual fund. It's a slightly different animal. Yes.
I have a question about the municipal bond funds.
Mm-hmm.
So you have that under the category for funds for income-oriented
Yes.
investors, but you also said that it's good if you're in like the high tax bracket, because it can be tax deferred.
Well, it's not tax deferred. It doesn't pay any tax. You don't have to pay taxes. No, it is an income because it's a bond. So, you know, the bond pays interest every month or every 6 months.
But you don't have to pay taxes on
But
that.
you do not have to pay taxes on the income that you generate from that fund investment.
But
I'm just saying if you do not pay taxes in a period, then a tax-exempt income doesn't do anything for you. You know, a tax-exempt income makes a lot of sense if you have to pay a lot of taxes. It doesn't make any sense to you if you don't have to pay any taxes, because a tax-exempt income is going to be lower than a taxable income. You know, so in other words, the income generated from a corporate bond fund is going to be higher than the income generated from a municipal bond fund. And the reason for that is because the income that you earn from a corporate bond fund, you have to pay taxes on. So that's what the market is going to recognize that, and the price of those, the net asset value of these two funds is going to be different accordingly. But the market can only price averages. The market cannot price a particular tax situation of a particular investor. So it's going to price an average tax rate. So therefore, if you are above that average tax rate, you actually benefit from being in a tax-exempt fund. If you're below that average tax rate, then you're not actually going to get a benefit from doing that. Yes?
Would you mind ranking the bond funds just kind of in terms of risk from top to bottom?
Oh, well, sure, I can do that. Basically, there's nothing safer than a U.S. government bond fund. We consider government bonds, U.S. government bonds, a risk-free investment. So it's a risk-free investment. You do not have the U.S. government has never defaulted on its payments ever in the history of the Treasury, and it's not likely to happen. So there are certainly the least risky, followed by Ginnie Mae, because Ginnie Mae is a government-sponsored agency, so it's backed by the full face of a credit of the government. They're not Treasury securities, but they're just one small step below. Corporate bond funds, global bond funds, you're going to have to look at the credit ratings of the bonds in that portfolio. And the credit ratings are global. So in other words, you know, if you get a AAA for a bond issued by a company in India and by a bond issued by a company in the US, it means the same thing. There's not a special AAA India rating and a special AAA US rating. It means the same thing across the world. Municipal bond funds, the same thing. They are rated. Don't think about that every municipality is like Jefferson County. Most are not. So therefore, municipal bond funds, normally municipalities do not go bankrupt either, but they can, and that's the difference. See, a government can never go bankrupt, and that's why you have to be careful when you think about government bond funds, sovereign bonds. That's what we call them, when, you know, especially when they're foreign governments, where, like Greece, for example. Greece theoretically cannot go bankrupt. As a country, you cannot go bankrupt. But you can stop paying, you know, you can do that. And there's nothing as an investor that you can do. If Greece were to decide tomorrow we're not going to pay any interest on the bonds anymore that are outstanding, there's nothing that you can do. You cannot take them to court, you cannot file bankruptcy on them, and, you know, kind of ask for the presidential palace as collateral or something. It doesn't work that way. Can't go to United Nations, none of this is going to work. Municipalities can go bankrupt. Obviously, you know, we live in Jefferson County. We know they can go bankrupt. So that can happen. It's a very different process from a corporate bankruptcy, by the way, and it has very little in common with a corporate bankruptcy. But they can go bankrupt. But there are credit ratings on those too. So when it comes to municipal bonds, global bonds, corporate bonds, look at the credit ratings. And they will tell you, we only invest in AAA securities, or we're only investing in AA, or we have a mix of AAA and AA. And those ratings mean the same across those particular classes of mutual funds. You just have to look at what there are, you know. But the least risky is the U.S. government bond fund.
What are the typical returns for these funds?
Well, that depends on the, you know, every fund obviously is different. Now, the U.S. government bond fund is not going to return a lot right now, you know, because U.S. government bonds don't return a lot. I mean, they are going to reflect. The reason why you can say, why don't I just buy the treasuries myself? The reason why you can buy the treasuries yourself, because some of them have a face value or a denomination of $10,000. In other words, if you want to buy one bond, you're going to have to pay $10,000. You might only want to invest $1,000 in treasuries, then you go into a bond fund, because only $100 in a bond fund. You cannot buy a $100 bond in the market. It's not there. But you can buy a $100 bond fund. That's why in particular bond funds allow you to be an active participant in the bond market. It is very difficult to actually buy individual bonds. Now, it's easier for treasuries than for anything else, but they have denominations. And the minimum is $1,000 in the treasuries market. They go up to a treasury bill. If you wanted to buy a treasury bill, your 3 months, 6 months, $1 million. $1 million face value. So unless you have $1 million sitting around, you're not going to buy a treasury bill. You can't do that, but you can go and buy a U.S. government bond fund, or for treasury bills that would be some sort of money market, U.S. money market fund that only invests in those short-term securities. You can do that, but it's going to be very low. And the more risk you take, the more you're going to get. But you have to look at right now, for example, the average yield on a corporate bond is about 6%. You know, it's about 6% is the average yield on a corporate bond fund. So therefore, you're not going to get on a corporate bond. So therefore, a bond fund that you invest in, you're not going to get more than that. And if you do, they're taking more risk than the average bond has. If you get less, that means they're less risky, or they do not doing a very good job. Either way, you know, that's why you have to look at and compare with other funds. But right now, because interest rates are low, returns from those bond funds are going to be low. That's just the way it is. Yes.
Can you elaborate a little more about the Ginnie Mae? You say what, they changed the name? Are they?
No, I didn't read my thing right. Ginnie Mae has nothing to do with Fannie Mae and Freddie Mac. No, they do the same thing, but it's a government program for special mortgages.
Are they still named on the Ginnie Mae?
Yes, they're called Ginnie Mae. Yes.
They did not mingle with the Fannie Mac.
No. Fannie Mae and Freddie Mac are two other ones that are now under the umbrella of the U.S. Federal Finance Agency. Under the umbrella, officially Fannie Mae and Freddie Mac still exist, but they exist under that umbrella. They do not exist as independent companies anymore. because they were publicly traded companies. Both of them were publicly traded on the stock exchange. Now they were government backed, but they were publicly traded on the stock exchange. Ginnie Mae is not publicly traded anymore. Anyway, that is a government agency. Ginnie Mae is a government agency that makes special mortgage programs for certain you know, people, veterans, among those and other people. That's what Ginnie Mae does. You know, there are special mortgage programs, and that's a government agency.
Do they run into any problem right now?
Well, if they did, it doesn't matter because the government backs them up. Just like Fannie Mae, if you invest your money in Fannie Mae or Freddie Mac, you wouldn't have lost a dime. You would have gotten all the money that you were expected to get from those bond funds because the government backs them up. Now they're backed by the same full faith and credit of the government as the US Treasuries are. So therefore they carry more or less the same risk as the US government. The only difference is that theoretically the US government could say, now we're not going to do that anymore for Fannie Mae and Freddie Mac, and then that would change. They can't do that for the Treasury, and they would have to actually change the laws to do that for Ginnie Mae, so that it's not something that they can do overnight, and it's not something that they're going to do overnight for Fannie Mae and Freddie Mac if they ever do that. So, so you don't have to worry about these. And as a matter of fact, even though they're mortgage-backed securities, what these issue, they actually guarantee the payment. They guarantee the payment of interest and principal. That's why Fannie Mae and Freddie Mac got into trouble, because they actually guarantee the payments to be made to their investors. The problem is that the mortgages that they used to guarantee those payments did not actually produce any more interest income and principal payments. And that's why they had to pay out all that money to their investors, but the money wasn't coming in on the other hand, on the other side, and that's why the government had to step in and make up the difference. That's what happened to them, because they guaranteed their payments. The other ones, you know, that all went down and created all kinds of problems. They didn't guarantee any payments, so when the mortgage loans didn't make any payments anymore, so went the securities. That's the difference between those. Yes.
If a portfolio manager does the work of your investment, where would my broker come in?
Well, the broker is the one buying it for you.
Oh, good.
So you cannot buy yourself. You know, the thing is, you always have to go through a broker.
Okay.
You know, you're not allowed unless you have a license to do that, to actually buy those securities yourself. You have to go through a broker. You know? Now, and the other part of the broker is, you know, they're supposed to give you some advice if you want it, you know, and if you believe in that advice, you know. And some people are very good at that, and some are not. Just like with anything else, you know. Some people are very good at what they do, and some people are not as good at what they do, and that's not any different for brokers or financial advisors and anything like that. So, but yeah, you cannot. Now, you might actually have to talk to a person that said you can go online, you know, if you have an online brokerage account, and press the button and you buy and sell that mutual fund yourself, but technically you're still going through a broker. Even though you're doing all the work, technically or legally you're still going through a broker. So you're always going to go through a broker. Yeah. Yes?
So for the bonds funding kind of the internet, what is this mean is like I open one account and the identity. So I can search the bond, I can buy by myself. Or
yeah. What you want to do, you want to go to whichever. If you already have a brokerage account, you want to go to the homepage of that particular brokerage firm.